For decades, the Toyota plant in Georgetown, Kentucky was more than a factory. It was a symbol, a heartbeat, a promise that America's auto dominance would never fade. Generations built their lives around that plant. Thousands of families relied on its rhythm, a rhythm that once seemed unstoppable. But now, that familiar sound has changed. The hum has weakened. Production lines that ran non-stop for years are slowing, not because of a natural downturn, not because of market collapse, but because of a political decision that was supposed to save American manufacturing. Earlier this year, the White House introduced a sweeping 25% tariff, pushed as a bold, patriotic move to bring manufacturing back home. The slogan was simple: protect American jobs. But the reality that followed was anything but heroic. In a shocking twist, the policy meant to rebuild America's auto strength has instead triggered a wave of instability, one that's reshaping the entire continent. And while U.S. states are scrambling to control the damage, something unexpected is happening north of the border. Canada isn't just avoiding the fallout. It's rising. Quietly, steadily, methodically. And the shift underway might change North America's manufacturing map for an entire generation. But that's only where the story begins. Inside Toyota's legendary Georgetown plant, the slowdown wasn't loud. It didn't start with alarms or shutdown sirens. It crept in quietly, first as trimmed hours, then as halted Lexus production, and finally as a major cutback in the RAV4 line, one of Toyota's most reliable U.S. models. Workers still show up, machines still run, but the certainty that once defined the facility has faded. In surrounding towns, the shock is unmistakable. Restaurants have fewer lunchtime crowds. Truck drivers wait longer between loads. Parts suppliers cut shifts to save costs. The entire ecosystem, one built tightly around Toyota, is feeling the weight of a slowdown that no one thought possible. What's happening doesn't feel like a temporary adjustment. It feels permanent, structural, a shift strong enough to redefine where North America's industrial engine will live in the coming decade. For years, Kentucky prided itself on being a hub of dependable auto manufacturing. Yet now, the model that once made it a success is being tested by forces far beyond the state's control. Something bigger is brewing. But this wasn't an isolated slowdown. It was the first tremor of something much larger. When Washington introduced the 25% tariff on imported cars and components, the message sounded bold, patriotic, dramatic. The policy was framed as a rebirth, a way to reignite American factories and punish foreign automakers. But within months, the results painted a completely different picture. Automakers operating in the U.S. absorbed nearly $18 billion in extra costs during the first year. Over 20,000 vehicles per day vanished from the continent's production line. In just a single month, parts shortages triggered a 30% drop in output. Plants meant to ramp up instead pulled back. International automakers reacted fast. Volvo cut capacity. Audi shifted operations overseas. Hyundai pulled back its U.S. footprint. Those that stayed were forced to raise prices just to survive. The average new car price soared past $50,000, placing American families in an impossible position. The tariff that promised to strengthen American industry became a weight dragging it down. A policy intended to create jobs instead weakened the sectors it depended on: steel, parts manufacturing, logistics, and electronics. But while America tightened its borders and restricted access, another country saw an opportunity and seized it. While the U.S. took a defensive stance, Canada made a completely different calculation. Ottawa understood that the world doesn't reward isolation. It rewards stability, predictability, long-term thinking. And that's exactly what Canada offered, not just to its people, but to the world's biggest automakers. Instead of raising walls, Canada expanded partnerships. Instead of fighting global trends, it aligned with them. That clarity became magnetic. Honda stunned the world with a historic $15 billion investment in Ontario, one of the largest auto projects in Canadian history. The plan includes electric vehicle assembly, battery manufacturing, and a full supply ecosystem that will support thousands of high-skilled jobs. Toyota, too, expanded its footprint north, capitalizing on access to over 50 markets through trade agreements like the CPTPP and USMCA. Canada's clean energy grid lowered production costs by roughly 20%, giving automakers a financial edge that the U.S. simply couldn't match. Consistent policy became another advantage. No sudden tariffs, no political whiplash, no unpredictable shocks. And then the numbers started speaking louder than any political slogan. For the first time in modern North American history, the momentum shifted north. Japanese automakers, Toyota and Honda, now make nearly half of all vehicles produced in Canada. That's roughly 930,000 units per year, with Toyota accounting for about 500,000 and Honda producing another 430,000. Canada didn't just attract factories, it built an ecosystem. Research centers, battery hubs, supplier networks, and logistics lines stretching across Ontario, Windsor, and Quebec. Meanwhile, the U.S. saw its own giants pull back. Ford and GM trimmed outputs by up to 10%. Auto haulers recorded their weakest shipment levels in 15 years. The contrast became impossible to ignore. The U.S. was fighting its own policies. Canada was benefiting from its consistency. Slowly, the map of North American manufacturing began to change. Not through speeches, but through spreadsheets. Not through slogans, but through investments. And no company felt the consequences more sharply than Toyota. Toyota has a reputation for resilience. For decades, it weathered recessions, supply shocks, and global competition. But the tariff era hit harder than anything in its modern history. Global earnings dropped nearly $9.5 billion, the steepest fall among major automakers. In North America, Toyota shifted from profit to loss for the first time in years. Roughly $3 billion in tariff-related expenses drained its operations almost instantly. Executives admitted something that many already feared. Higher trade barriers don't strengthen an industry. They relocate it. And the relocation wasn't going to America. It was going to Canada, Mexico, and Asia. Across U.S. towns built around Toyota supply chains, the impact spread like ripples. Reduced shifts, slower demand, less freight, smaller paychecks. Communities that once depended on Toyota's stability found themselves navigating uncertainty. But the storm wasn't done. The next shock came from the EV sector itself. Even as automakers tried to adapt to the pressure created by new tariffs, another storm was building quietly inside the electric vehicle sector, a storm no one fully saw coming. For years, the EV transition was sold as the future, cleaner, faster, more efficient. But behind the polished marketing and futuristic prototypes, real cracks were forming. And in 2025, those cracks widened into full-blown fault lines. One of the sharpest shocks came from a place almost no one outside the industry had ever heard of: Nolis, a major aluminum supplier. When a fire tore through part of its operations, the impact didn't stay confined to a warehouse floor. It rippled outward instantly. Ford, one of its biggest clients, saw production disrupted so severely that analysts warned the financial damage could approach a staggering $1 billion. It was a blunt reminder that modern auto manufacturing is so interconnected. One disruption can set off a chain reaction. But that was only the beginning. On the consumer side, trouble was brewing in the lending market. Subprime auto loans began collapsing, exposing how stretched lower-income buyers had become. Used car giant CarMax raised red flags as delinquencies climbed and credit conditions tightened. Families who once relied on affordable used vehicles suddenly found themselves locked out of the market entirely. Rising prices collided with shrinking credit access. a dangerous combination. Meanwhile, the EV market itself wasn't delivering the lifeline automakers hoped for. Battery expenses kept rising. Consumer hesitancy lingered. Demand cooled, especially as higher interest rates and expensive new models pushed many buyers toward older vehicles instead. Companies investing billions into EV platforms began privately admitting the transition would take far longer and burn far more cash than early projections promised. Tariffs were already squeezing margins, supply chains were unpredictable, and now EV volatility added another layer of instability. Yet amid all this uncertainty, one country continued moving with surprising confidence, and it wasn't the United States. While the U.S. auto sector scrambled to contain damage from tariffs, fires, lending stress, and slowing EV sales, something very different was happening north of the border. Canada wasn't just avoiding the chaos, it was turning the moment into a long-term strategic win. A quiet realignment was underway, and experts who once dismissed Canada as a secondary manufacturing player were now recalculating their models. Analysts began piecing together the numbers, and the trend was unmistakable. If current patterns hold, the United States could lose up to 25% of its auto supply chain by 2030. That's not a dent, that's a structural retreat. Meanwhile, Canada is projected to secure up to 40% of North America's entire EV and battery capacity, the kind of dominance no one predicted 10 years ago. Why Canada? The answer was surprisingly simple: stability. Investors trusted a country that didn't change industrial policy every election cycle. Automakers trusted a government offering long-term clarity, clean power, and trade access to more than 50 global markets. Suppliers trusted predictable costs, and consumers trusted a system moving with strategy, not slogans. Behind closed doors, industry executives spoke plainly. Canada wasn't just competitive, it was becoming the new center of gravity. A place where global automakers could build billion-dollar ecosystems without fear of sudden tariffs or political whiplash. A place where clean energy grids lowered costs. A place where incentives came with certainty instead of controversy. In boardrooms from Tokyo to Frankfurt, conversations were shifting. The question wasn't if Canada would rise, it was how fast and how far. Because for the first time in decades, the continent's manufacturing future wasn't being decided in Detroit or Kentucky. It was being shaped in Ontario, Windsor, and Quebec, quietly, steadily, and with unstoppable momentum. By the time the numbers settled and the industry dust began to clear, one truth stood out above everything else. North America is not the same continent it was a decade ago. The shift isn't loud or explosive. It doesn't arrive with breaking news alerts or dramatic headlines. It moves quietly, the way real power shifts always do. For the first time in generations, America is not the automatic center of manufacturing gravity. The pillars that once held its industrial dominance, cheap energy, predictable policy, abundant labor, and unmatched stability, are cracking under the pressure of volatility and abrupt political swings. Tariffs were supposed to rebuild the walls. Instead, they exposed the foundation. Canada, meanwhile, didn't fight the storm. It navigated around it. While the U.S. locked itself into defensive postures, Canada opened doors. While American companies were battling cost spikes, layoffs, and shrinking supply chains, Canada attracted multi-billion-dollar investments from the world's most sophisticated automakers. While political cycles in Washington shifted every 4 years, Ottawa built a plan for the next 40. And slowly, the map began to change. One factory at a time. One battery plant at a time. One investment at a time. Today, the momentum lies unmistakably in Canada's direction. The U.S. still has size, legacy, and history, but Canada is shaping the future. Cleaner, calmer, strategically aligned, and globally connected. The world's automakers see it. Investors see it. Executives whisper about it. Even analysts who once doubted it now acknowledge it. This isn't the story of America collapsing. It's the story of Canada rising. Steadily, predictably, and without asking for permission. By the end of this decade, the continent's industrial engine may beat from a new heart. A northern one, a quieter one, but a stronger one. And the shift is already underway.